China's stock rally fading just a bit. The Shanghai Composite falling more than 6%, and the Hang Seng down more than 1% after yesterday marked its worst day since 2008. Of course, though, coming on the heels of the massive run-up that we saw last week. Yahoo Finance's Alexandra Canal is here with a closer look. Allie.
Yeah, Shauna, so that you mentioned the Hang Seng index, that's loaded with large Chinese companies, and we did see that drop another 1% today. So continuing those declines that we saw yesterday. You mentioned China's benchmark CSI 300, that dropped 7% along with that Shanghai Composite as investors really are fully digesting this news. And what it really boils down to is that expectations were for a supersized stimulus package, and what we got on Tuesday was pretty much a nothing burger. Now remember, back in September, we saw the most aggressive stimulus from China since the pandemic, with the country saying it is committed to reaching its 5% annual growth target. That's part of the reason why we've seen such a run up in these stocks. And investors, they believe that there's more fiscal policy to come due to that commitment from China. But Wall Street is split at this point about whether or not now is the time to buy into this market. Here's one point of view about why maybe you should sit on the sidelines for now. Take a look.
We think long term, we'd rather be in India, Japan over the long term. The short run pop is, hey, people are feeling better, they're starting to stimulate. Will it be enough to move their economy? Is very much an open question. The sentiment was so negative, but there's also good reason why it's tricky.
That's Jeremy Schwartz, Chief Investment Officer at Wisdom Tree, and he's very focused on the geopolitics of it all and the risk that comes along with that. But on the bullish side, we've seen Goldman Sachs, HSBC, BlackRock, all upgrading mainland China stocks in recent days. A lot of that has to do with valuation still at historic lows, and with hopefully more good news to come on the stimulus side, that should be bullish for China in the long run. But that's the big TBD factor that really has investors on edge right now.
Well, it's interesting, too, because there's this question out there about whether or not the stimulus is just a sugar high, because ultimately consumers have to recover and have to be spending for us to see kind of a long-term recovery. What does that look like to you, Allie, in terms of where China stocks are going and what the next big mover for those stocks could be?
Well, we've really seen those consumer staple names, a lot of the e-commerce giants, Alibaba, JD.com, they've seen such massive surges. We are down over the past 2 days, but still we are up significant double digits there. And yes, the stimulus is going to have a trickle-through effect through the economy. There's mortgage relief, there's debt relief, which I think is something that a lot of the consumers are really looking for. But it seems like we need more support on the fiscal side, not just monetary. Economists, they're expecting a big number of fiscal package worth $284 billion to be announced. That seems to be the magic number there. And that also is what was probably expected from yesterday's announcement, which we just did not get. So the fact that we've seen this policy fatigue since the pandemic, China has said they're going to do more and they just have not. That is a bit of the frustration there. But given that we saw such a significant package in September, that certainly shifted the narrative. So if China can't come out and continue to bring that fiscal policy, bring that big number, we're going to see those depressed levels in the stock market. And we're going to see that pain really echo even more. So, it's something that size and execution, that is the two things that people are really focused on.
Yeah, and it's interesting given that we know so many hedge funds have been very bullish on China, but it looks like it was just a 2-week stint, at least for now.
For now, we'll see.